Welcome back to Financial Understanding, Finance for Understanding. Today we have a great episode. We're going to talk about investing. What is investing? Oh my goodness, I love investing. It brings me so much joy just talking about all the rich information and with investing. It's just the greatest wealth builder. It'll help you find financial happiness, or it'll help you achieve many great financial goals in your path. Today we're going to talk about what is investing and the great amazing wonder that investing entails with it, like being able to understanding what society pictures of investing when we talk about it, because you might be shocked about all the different perspectives on it. And I want to talk about different types of investments. You might be like, real estate, gold, crypto, what is it? We'll talk about it more in depth for you guys, so you can understand investing and you can be able to pick which is the best for you. And I want to be able to articulate it, secrets that comes with investing, and being able for you guys to have the best opportunity for you. And we'll close off with a fairy tale. And I'll create a part 2 episode, creating the nuanced, sophisticated part of investing, like with the risk and the reward. Investments, I should say, are a real good thing to know. I want to state a crazy statistic. In the past 25 years, I want you to comment down below what you think it would be. The past 25 years, what do you think the average investment amongst Americans is? It fluctuates between 25 to 65%. According to Statistica.org, it averages between 62%. Yeah, that's why I will say, coming off the financial crisis in 2008, that when it took a big toll, which you can arguably state why that was because of toll. Well, it just puts it into perspective what investments in the market look like versus some. There's different types, and if you subset that category, it breaks it apart into different type of socio types of people and stuff like that. What society pictures upon investments? Most people don't know where to start. They might have a cautious perspective on the economy, and they just don't know where to grasp that opinion, and that just leads to like people being like, what do I do? Most people, they might have a cautious perspective on the economy, and that might subconsciously, they might not want to address it and be like, investments, it's not affecting me. I just want to point out a survey found that most American consumers have a savings account of 69%, checking account of 83%, even a retirement account of 49%, but only 31% have a non-retirement investment account. That's pretty crazy. This survey was calculated by Stats.com, and there's a fear-based vibe around investments amongst some, because if you, for example, traders, they might lose. I think 7 or 8 out of 10 traders lose. That's not, if you're investing in the stock market, and they have a term called investor, which is kind of you're just in it for the overall market. So that might create a fear-based vibe in a social stigma. If nobody around you invests, then 9 times out of 10, I'm just picking that number out, you wouldn't invest. And 70% of those surveyed said they feel strongly or somewhat optimistic about their financial future. Yes, because every person wants to strive to be their best, but they just might not know how to go around these investments. And I want to be able to cultivate for you an understanding of what exactly investing, or investments, and how do you go about it. So investments, in terms of what it sounds like, it buys an asset or something with the expected value to return higher. A good term of this is ROI in the finance world, which stands for return on investment. So for example, if you want, let's just say you buy a house and then you expect it to go up X amount of dollars in that time period, that would be your return on investment, which is great. And the stock market, you expect your stock portfolio to go up, whatever it is, which we'll dive deeper into that in a later episode, and what these numbers actually mean. I would say just a good rough estimate. I've said this in my previous episode. The S&P 500 returns about 10% each year, which I'll talk about what an index fund is. That's an index fund. Oh my gosh, those are so good in my opinion. Just being able to understand these investments and how they work, because they help you build wealth. How I was saying earlier, that is how you gain more wealth and more money and more equity, which helps one out in many different ways. Certain kinds of investments, let's tap upon this. Real estate is an example of an investment because you buy it and then the property goes up in value in most cases. And then the stock market, so it's not the stock market, but yeah, that is that. So a stock is an investment. Let's just say you buy X amount of this stock, you're buying equity of that company. Like, let's just say you buy Apple stock, it goes up, that's an investment. An ETF, an exchange traded fund, these are a basket of stocks, and what it is pretty much the S&P 500 is a famous example. It tracks the top 500 companies. So imagine you have a basket and all these stocks, Apple, Microsoft are in it, and it's tracked all together. I think the S&P 500 recently closed, its high is 6,100, so it's like floating around like right about like $6,000, which is pretty good. Gold is an example of an investment. Bonds, which are like government bonds, they typically mirror off the interest rate. Mutual funds, which is when you have somebody on your portfolio, there's normally an expense ratio higher on that one. That one kind of compares index funds or exchange traded funds, ETFs, either or. A business can be an example of investment because you buy that investment and then you expect it to go up in value. Some people sometimes compare businesses and real estate in terms of both options because that's a whole different concept. So secrets that investing entails. So I love investing. It just builds. This is this is back where that compound interest is. We're just talking about in more nuance, and there's different types of investment. This is where the wealth is built. I think there's a rough statistic, after 30 years, then that's where your wealth starts really, when I mean really, after 30 years, it just really starts exponential. It's like an exponential function if you're learning about that in math, which is crazy. Compound interest never goes away. So back to how I was saying, it's a wealth builder. It's a fundamental of how you build wealth. These assets that you have, or equity, it just builds and it just piles up into just more and more and more and more. And how I was saying just like a moment ago, the earlier you start, the more you're gonna have typically. For example, how I was saying that it just becomes more exponential. And having a diverse portfolio is crucial, is I would say oftentimes good, because like to say for example you buy a bunch of crypto. If you have all your portfolio in crypto, then those investments, and if it's not doing so well, there's and you want to keep it balanced. For example, and a risk tolerance is a very prominent example. That's a big part, like where your risk stands, like how old you are. We'll talk about that in the next episode, so you can really go about what's your risk tolerance and how do you go about that and finding it. And I have some tips on how to do that. I just want to say a quote from Warren Buffett: price is what you pay, value is what you get, from the one and only Warren Buffett. So that, I just want that quote to resonate with us for a second. So the price is what you pay. So you can do this on investments and the value might go up. But for example, let's just say you buy whatever it is, you buy a book can be an example. I just have a book right next to me. That can be an investment. Say a car, for example, you might buy that, but the value might be in X amount of years, might be lower. So the price is what you pay. Or yeah, for example, a book, it might give you so much knowledge, whatever it may be. And I just want to point out, for example, some might say investment is a cash. Cash is an investment, but cash actually depreciates in value, which is actually because inflation is typically 1% to 2% each year, which it loses its value. So let's talk about our fairy tale. Okay, so Timmy Timmy. Timmy starts investing, okay? In all kinds of investments. We'll name them in a second. And he decides he wants to explore and investing, okay? And let's just say he's younger. He has a diverse portfolio all across stocks, bonds, real estate, and we can say some crypto for the crypto people out there. Maybe even, I don't know, whatever you may want to, whatever else you want Timmy to have. And over time, these assets start going up in value. And that patience virtue, which is a big part if you're really wanting, that's very important, what to learn and how to practice in your life, being able to cope with that. And over time, his decisions, which leads to his wealth growing, and ultimately in the end, in order for him to whatever your financial goals are, which is back to that 70%, but most people just might not know how to ultimately go about it, which I want to give you this knowledge of what investments are and how you can apply it in your lives. Next time we'll talk about that more risk factor and nuance and areas of investments in more sophisticated detail, because it is not a complex system, but if you just don't understand it much, it takes some understanding, and I'll talk more in detail about this investment. So yeah, thanks for watching, and I hope you share and follow us on whatever platform you're listening to, and yeah, and giving us a like and a share with someone. That will help me out immensely. Thank you for watching, and yeah, have a great rest of your day.